Raoul, thank you very much for joining us today. How are things in the Caymans?
I can't complain. It's a bit cold today. Look, I've got a sweater on because it's 75 degrees. This to me is like Arctic weather.
Yeah. Well, I am in Toronto and I can assure you it's significantly colder. So there's many beautiful islands in the Caribbean. Why did you decide on the Caymans?
Um, by random accident, I was shark diving in the Galapagos. I'd had two dreams in my life. One was to live in the Mediterranean, and one was a tropical beach. I love diving. I love white sand, turquoise water. And I was living in Spain. I was on this dive boat in the Galapagos, speaking to a bunch of people. I said, I've got this other dream. It's this tropical beach. And they're like, well, we're from the Cayman Islands. You should come down there. And I was like, no, it's not really what, because Grand Cayman is a bit more suburban. I'm like, I want nature. They said, well, you could try this crazy island called Little Cayman. It's sort of weird. And I came down to Little Cayman where I am today. I live between Grand Cayman and Little Cayman. I built my house in Little Cayman today. I came down here day two. I bought a piece of land and built a house, which was a brave thing to do. It's an island of 150 people. Not the easiest thing to do to build a house.
And you've been there for how long now?
11 years.
Ah, fantastic. That's a great story. I've never been to the Caymans. I got to check it out sometime. So let's move on now. And I want to talk about the economy. And I want to get your opinion on the global economy. And if you have any concerns when you look at the various regions in the world, whether it be Asia, Europe, or North America.
So, generally speaking, the economic cycle, and I'll use the ISM survey, Institute of Supply Managers survey from the US as the best guide, has been subdued. So even though we've had equity markets and stuff very strong, the economy's been subdued. So normally a growing economy, you should see the ISM above 50. GDP's actually been reasonably good, but there's something going on in the kind of manufacturing sector that is still sluggish. So the cycle has still been relatively slow, which has created this bifurcation of like tech stocks, which are not based on, debt dynamics or real world expenditures. It's a very separate kind of cash flow that they're earning. The traditional economy has been sluggish. Globally, Europe's slow. They haven't picked up yet either. The UK is a bit of a mess. Canada's slow. And then we go to China, and China's got a full on debt deflation playing out. So bond yields are collapsing. They can't stimulate because their currency's too weak and they don't want to lose control of their currency. Everybody's desperate for the US to weaken the dollar because the dollar's way too strong for everybody. So the strong dollar usually slows the global cycle. Now, Trump's coming in. The probability is he'll do the same as he did last time, which was the dollar's too strong because the US needs to export goods. And a strong dollar means less exports, which means a larger trade deficit. So we're kind of a little bit in this no man's land where everything is slow. All the forward-looking indicators of the economy are suggesting, because the liquidity that went in and financial conditions over the last 6 months, they tend to be forward-leading, suggest that the economy should pick up significantly this year. Now, China's the one problem child. We have to, as I said, see the dollar weaken, but also the Chinese need room to stimulate. So then they can try and stimulate their economy. Now, the reason they're seeing this debt deflation is the same that we've all had similar issues, is too much debt, aging population, doesn't generate enough GDP growth to service the debts. And what you get is this big problem. And they've got it in the real estate sector, much like we all had back in 2008 and 2012 in Europe. They've got it in the banking system, much like the everyone had in 2008 and 2012 in Europe. They've got the same set of problems because their demographics just are falling off a cliff.
So you expressed some concern about the US economy. And when I look at the US economy, and I see the same thing in Canada, but it's like you have two different economies. You have people
Yeah.
that are doing extremely well, and then you have another group that are not doing well. And in spite of the fact that the government is saying the economy or the GDP is growing at 2.5 to 3%, they say they got inflation under control. The S&P and the Nasdaq trading at or near all-time highs. There's still this sense that things are not really as strong as they are. Do you have any other concerns about the US economy? And where do you see it going this year? Do
Yeah,
you
so
think it continues to
have
chug along at 2.5 to 3%?
yeah, I don't have any structural issues with the US economy. Um, I think that that bifurcation of the two different worlds people live in is real. don't forget the average person is dealing with very high mortgage rates, very high credit card debt interest rates. They're dealing with still low cash flows from their regular businesses. We're not talking about tech giants here who are changing the world. We're just talking about people who run small local businesses. It's still not great. And, we have to get rates lower and stuff for that to happen. And the inflation, yes, the rate of inflation's come down, but the price is stuck. It's still sticker shock every time you go anywhere for dinner. You're like, oh my God, how did this happen? These prices have doubled. That's a real problem. And what we need is the economy to grow. Now, Trump and his team know this. Scott Bessent, somebody I've known for a long time because he was an ex-hedge fund guy, and he's a friend of mine. I haven't spoken to him for a while, but he understands what needs to be done, and that's we need to get growth. So growth to me is, yes, you need to get interest rates lower. Yes, you need to get the dollar lower. Yes, you need to stimulate the US economy. You need to deregulate the economy. So all of those things on a forward basis suggest that the economy will be much stronger. Whether GDP changes much below, trend rate of GDP growth roughly is about 2% or just below it. We've been trending higher recently. Do we go much higher? Do we have a few periods of 3.5% growth? Maybe, probable. When you have a new administration, there's tax cuts, there's all of that stuff. You tend to do that, and Trump is very driven by the economy more than anything else. So I'm optimistic. Do the Europeans manage to get their shit together or not? That's a different issue, because they are doing the opposite. They just keep increasing regulation, increasing tax, making it harder for people. But they have the difference, they have a social security net. So it's a different structural system. And then we do need China because China buys goods from abroad. They don't just sell them to us. They also buy stuff from us. And if they're on their knees with their economy, they're going to be buying less goods. So we need the global economic system to get fired up. So we need the US Trump to do what he's suggesting he's doing and allow the Chinese to figure out what they need to do.
You are so right about inflation being sticky. And I noticed that in Toronto. Like I was in Whole Foods the other day and their beef tenderloin, something I enjoy very much, was $60 a pound. Okay. And that's Canadian. So that's probably 45 US. And it wasn't that many years ago when it was 30 bucks. Okay.
That's
And
right.
those prices are never coming down again.
I was in New York City and I went out for two dinners and I was on my own. I was having to go to some event, so I thought I'd just round my hotel, go for dinner. First night was a pretty crappy steak restaurant, and I had two glasses of wine, a steak, and a salad. It was 180 bucks. And the following night was a nice restaurant, um, but again, it was $300 on my own. I'm like, this is insane. And you go to Spain, for example, where I spent, I lived 10 years in Spain and had a house there for 20 something years. You can go to a three-star Michelin restaurant, go high end on the wine list in one of the best restaurants in the world, and it will cost you 250 euros. So we've got some real problems here somewhere.
100%. So Stan Druckenmiller has stated that the biggest risk he sees to 2025 is this reacceleration of inflation. Paul Tudor Jones had similar comments. He said all roads lead to inflation. And I think their concern is that lower taxes, higher tariffs, deregulation, deportation will all be inflationary. What are your thoughts on that?
Um, I am not an inflationist. The business cycle, when it picks up, will create some inflation again because oil prices will eventually rise and stuff like that. But I'm not an inflationist. There's two different things going on. There's debasement of currency that inflates asset prices. That's continuing. Inflation itself, I see less so. And all I see ahead is a tsunami of technology that is so deflationary we can't get our heads around it. So yes, we will get business cycle inflation. Where will inflation end up in this cycle? I think it ends up below 2% and then picks up again and maybe gets to 4% and then comes off again. So I'm not wildly concerned by inflation, but as we said, those prices won't fall. So we've still got that issue. But if I look further ahead, I think this is maybe the most deflationary period anybody's ever lived through because of robotics and AI. It's we're creating infinite people, or people in inverted commas, at zero cost. I mean, Amazon now employs more robots than people. So they're the largest employer in the United States, I think, outside of the Postal Service, or maybe the largest employer. But they have more robots now, and the robots work 24/7, 7 days a week, never complain, never take a tea break.
That is a great stat. And they never go on strike either.
Exactly. They never complain, don't have any HR issues, nothing. And so, look, if you step back, it means that everybody is economically incentivized to use technology as opposed to people. That's a fact. Go to a Tesla factory, it's all robots. Go to any modern factory. So even if the re-onshoring of manufacturing in the US, a big Trump thing, they're not going to employ people. It's not the 1950s anymore. This is this is a very, very different world where nobody employs people if they can avoid it because technology is so much cheaper and more effective.
We are living through fascinating times.
Yeah.
So I'm going to get your thoughts on the 10-year, okay? And it's been very strong. The yield's gone from 360 in September, it's up to 460, 470 now. And this is in the face of three cuts by the Fed. What is this telling us? Are you concerned at all about the 10-year yield climbing?
I am because it's tightening financial conditions. It is also decoupled from inflation expectations, so it's not about inflation. So what is going on is every 4 years, all of the major governments around the world have to roll the debt. Now, it's this 4 year cycle, something I call the everything code cycle, because in 2008, there was a debt jubilee of where they reset interest rates to zero. All of the governments, therefore, didn't have to pay interest for a while. So it was a break on interest. So it was like a debt jubilee. It's like, don't worry about it, guys. Don't pay your interest. Sort out your debts. They all restructured their debts into the 3 to 5 year sector. And so 4 years being in the middle of it. And it's created this perfect cycle that's been happening since 2008. What has happened this time around, because we had the pandemic inflation, it's been very late for them to cut rates. Normally, in this point in the cycle, they would have cut rates back down to trend rate of GDP growth, let's say 2%, but they couldn't. So what's happening is the debt is now compounding into new debt because they're issuing new debt to pay old debts. And so what you've got is a tsunami of debt that's happening, which is why they need to get interest rates down. So it's that dynamic that's causing it, is the issuance. Something will give at some point. Either the governments are going to have to stop it because everyone's got the same problem, and the UK interest rates just hit what it was like a 30, 40 year high. It's unsustainable in highly indebted economies. So they're all going to have to do something. Now, whether it's a yield curve control idea, which is they kind of, as opposed to forgiving all the debt payments, they say, we're going to cap interest rate on government debt at X%. Or you have to do QE, but certainly what they're desperate for is to add liquidity into the system. There's a tightness of liquidity that stops people buying the bonds, which is why the excess issuance isn't being bought. The other issue is the dollar's too strong. So it's expensive for the Japanese and the Chinese and the Europeans to buy US government bonds. So again, it's another reason they've got to get the dollar lower, got to get the rates lower. And then I think it'll free up the 10 year. Trump has already said interest rates are too high. And I think Scott Bessent's first job is to figure out this particular mess.
And so where do you see interest rates going, or where do you see the 10-year going? Like, does it go to 5%? And if it does, what does that do to the equity markets?
Look, I think, again, if we talk about the equity market, that bifurcation, I think it makes no difference to Google, Apple, Meta, OpenAI, none of these guys, because those guys compound growth at 30% a year. So a 5% hurdle rate. Don't forget, they all sit on cash. So they actually make more money as interest rates go up, which people don't realize. So I'm not worried about that. If inflation came back, then you have to discount the cash flows. But with rates up, it's not an issue. It is for the regular economy, which creates this bifurcation. And I think that, look, there is a risk that it goes to 5% and 5.5%. So I think there is going to be some pressure from Trump to organize this as fast as possible. The other side of the equation that makes some complexity to it is Trump wants to renegotiate trade terms with everybody, whether it's Canada, whether it's China, whether it's Europe. And the best way to beat everybody into submission is a strong dollar. And so, because they all have dollar debts as well. So, what he's going to do is use the strong dollar as the stick and then offer the carrot. And the carrot will be, we will lower the dollar if you agree tariffs or changes in the trade deficits.
So let's just talk about the dollar because I can't get over the strength of this dollar. It's crazy, especially against the Canadian currency. The Canadian dollar is at a 22-year low. It was down 10% alone in 2024. But how will they get the US dollar lower?
Well, really, if the US just says it wants a lower dollar, it actually tends to work. The other way is giving access to swap lines to China, Japan, and others who have large dollar borrowings. So that's an injection of liquidity directly into those countries. And then they can recycle that into buying treasuries. That's usually how it works. So there's some way of the US via the Federal Reserve lending money into the global system to alleviate the dollar shortage that those people have. They recycle that because they have the dollars, they buy treasuries, and everybody's a winner. So that is the mechanism. So then you ask, well, why are they not doing that? Why is the dollar so strong? It's because they want it strong. And the reason they want it strong is to quickly get an agreement on trade deals.
So when I look at all of the elements that we just discussed, okay, I have to admit I'm somewhat perplexed by it all because the way I look at it is Trump is coming into power. He's going to do anything and everything he can to keep this economy growing at 2.5 to 3%, to keep the S&P and the Nasdaq at or near all-time highs, to keep the housing market going. But at the same time, he also wants to implement lower taxes, higher tariffs, deregulation, all of which could be argued to be inflationary. You don't think it is, but let's just assume they are. If it's inflationary, that to me, that means we're going to see higher interest rates. We're going to see a higher US dollar. But at the same time, Trump wants a lower US dollar to bring manufacturing back home and keep that economy going stronger. How do you reconcile all of that?
Well, when you listen to Scott Besson, you listen to a few of the others, one of the other things, why are they talking? What is this nonsense with Canada? What's that all about? It's all about oil. Trump knows, as does Scott Besson, is we need lower oil price. Even though it's not particularly expensive right now, but a lower oil price gets the economic machine working. And they want the Canadians to pump as much oil as possible, the Keystone Pipeline, all of those things. So look, there's lots of moving parts. Some are inflationary, some take time, and others are simple fix. A simple fix is you can add liquidity via either the Federal Reserve or via the Treasury, and you can stimulate assets. So they've got that under their control. So then somehow you need the economy to grow enough via deregulation, but you don't want it inflationary. So you're trying to keep a cap on commodity prices. There's a lot of moving parts here. So look, it's not an easy thing. And we will definitely, as the economic cycle picks up, we will definitely see inflation come back. But the question we ask ourselves is it coming back in a non-cyclical structural fashion where you see that chart that goes around Twitter all day about the 1970s all over again? Is it that, or is it just a normal business cycle where inflation picks up and then it goes down again?
So I want to get your views on the.
So it's quite a fine line to draw, right? I think you're correct. It's like this is not straightforward. We have problematic economies, and it's not easy.
Yeah, and I guess just a lot of uncertainty about what policies are going to be implemented in the coming months with the new administration.
And last time around, the tariffs weren't inflationary. So that's interesting too. So it's not necessarily guaranteed because the exchange rates can offset them and stuff. So it's really not clear. But Trump came in with similar policies last time. The dollar from second week of January fell like a stone. Bond yields had backed up for the same reasons. This is all inflationary. Bond yields fell for the next 18 months. So I think often the market can get wrong-footed by getting ahead of itself. I think to the point you're making now as well is like how long before actual large tariffs get put in place? Well, that's going to take a while, 18 months, 2 years. So in which case the incremental tariff increases will be small. So there's a lot of, we all think it happens on day one. It won't.
I want to get your views on the S&P and the NASDAQ now. We've had two incredible years, 23 and 24. S&P and NASDAQ up 25 to 30% both years. I read in one of your letters, you had an incredible 2024, up 150%, one of your best years ever. I'm going to have to give you some of my money. But what are your thoughts? Do you think we can have a third incredible year in the S&P?
So I'll use the NASDAQ as the best example. 97.5% of the entire trend of the NASDAQ is driven by liquidity. So it's a 97.5% correlation. So really what is driving equity markets is the action of the Federal Reserve plus the Treasury. And that's the Treasury General Account, that is the reverse repo, that is the balance sheet. And then in addition, it's what the global governments are doing. So global liquidity is the big driver of everything. So if we know that there is, I don't know, 8 trillion or 10 trillion of debt to roll this year, the bond market's already struggling, they need liquidity. Well, the probabilistic outcome is we're going to get a lot of liquidity. Trump also likes high asset prices. So the chances of this being another strong year for equities is high. It will be probably volatile, probably more volatile than last year was. But I don't see a world in which it won't if the government rolls its debt, which it has to do. And it's the same for the Europeans, it's the same for the Chinese, it's the same for the Japanese. Everyone's got the same thing to do. And to do that, they inject liquidity.
So it goes back to the point I made earlier. He's going to do anything and everything he can to keep the economy going, keep the markets going.
Yeah, number one, roll the debt. That's the single most important thing, because if you blow up your entire bond markets, that's the end of the game. So rule number one, roll your debt. In doing that, you have to add liquidity, and that's going to drive asset prices. So it's going to make him look good.
And what about valuations? When you look at some names, I'm going to throw it NVIDIA, right? That's the poster child for this market. I think it was up 170% in 24. Are you concerned about valuations with NVIDIA or any other names?
So generally speaking, PE ratios have been rising over time. And why is that? It's because the price is driven by debasement of currency, and earnings don't go up as much. They're driven by GDP. So if you're debasing the currency by 8% a year and GDP growth is 2% a year, earnings from a corporate level grow at 2% a year or whatever the overall number is, 5%, whatever it is, nominal GDP. So let's call that 5%, while debasement is growing 8% a year. So the P ratio keeps going up. So we can't use that. But, are people over extrapolating the impact on revenues of AI and stuff like this? Probably. But, don't forget, go back 10 years, 12 years. Yeah, between 10 and 12 years ago, 10 years ago, Amazon was trading at a P of 600. Still was a pretty good investment. So it depends on the rate of growth. However, my general construct is this year will be a good year. We will go to much higher valuations. And then after we've rolled the debt, we tend to tighten liquidity because the inflation pressures have come back somewhat. That tends to draw down the markets. We kind of reset again before we start this cycle all over again. My working hypothesis is this is going to be, valuations will get expensive this cycle. The correction may not be large, maybe just be a year of sideways, down 15% something. But the next cycle, because that's when AI, robotics, self-driving cars, missions to the Mars, all of this starts hitting, we will go to a full bubble cycle. And then we can think about what the world looks like after that. So I kind of think we're in a golden bull market, at least until the end of the decade.
And so if I speak to you in a year from now, do you have a target for the S&P?
It probably does another 20% from here.
That's good news.
Yeah.
So I can't have a discussion with you without discussing Bitcoin. I know you're very bullish in the long term, but I saw an interview you did recently, and you think it's going to have a good year, but there's going to be a lot of volatility. Maybe you can just take us through your thesis.
So Bitcoin is also driven by global liquidity, but it's also the adoption of this new technology, which puts it in this stupid exponential secular trend, but with volatility. The volatility, the big volatile drawdowns are just driven by liquidity. So this year, we've already established is a liquidity positive year. In fact, a very big liquidity positive year because you need to roll all of this debt. So generally speaking, it should be a very good year for cryptocurrencies. However, we're in this period where the Federal Reserve and the Treasury, and because of the dollar, have tightened liquidity over the last couple of months. It's forward looking, so it's affecting cryptocurrencies right now. So they've been soggy for a while because liquidity was tightened a while ago. But again, our expectation is it shouldn't last that long in price or time. And then we've got liquidity all the way through this cycle. Now, if we go back to 2021, the prior post-election cycle, because the pandemic had seen the global economy go down to zero, then go straight back up again, the business cycle peaked really early in April 2021. Normally in these presidential election cycle years, the business cycle peaks towards the end of the year. So Bitcoin had a very complicated 2021, but what we're doing now looks very similar to the 2017 post-election for Trump. And what we saw then was ongoing injections of liquidity. We started the year with a sharp 30% correction or 25% correction, the sort of thing we're getting now. And then liquidity just came all year. And it wasn't actually massively put in by the US. It was actually China last time. And I think we might see that again this time, where China is going to play an important role in global liquidity. So I think it's going to be a much stronger year than people expect. People have a lot of PTSD from 2021, where it peaked early, then collapsed, then went back up again, then collapsed. I think it's going to look more like we saw in 2013, 2017. So yes, I remain very bullish for this year on all risk assets.
So if I use similar numbers, let's just use round numbers. It's at 100,000. You see it pulling back 25% to 75, and then take off
Probably
again to
not even, I don't think it goes down 25% because there's ETFs and the market is more mature. So let's say let's say 90,000. So it goes from 100 and where did it get to? 110 down to 90,000. Okay, that seems about right. So not far from where we are now. And then it finishes the year in a worst case scenario. I think it's like 200, 250. In a base case scenario, it's kind of 350. And in a blow off top cycle like 2017, back end of the year, could go north of 500,000. It's difficult to know. So I always kind of give a probabilistic tree of, these are the
Yeah.
kinds of zones.
Do you have any views on gold?
Look, gold is driven by the same thing, which is debasement of currency. It just doesn't have a tech adoption curve, so it doesn't go up as much. So gold will, considering again, we're in the liquidity cycle where you have to debase currency to pay your debts, gold should continue to do well. Yeah, I'm bullish gold. And I think that'll continue to do well for the rest of this market, particularly when the dollar starts falling as well, that's good for gold. So overall, I think it's a very good market for gold, very good market for most risk assets.
So you often say in a lot of your online interviews that we have 5 years to make a lot of money. And I think you touched on this a little bit earlier when you were talking about AI and robotics, et cetera. But maybe you can provide some more context. What exactly do you mean by that?
So my job as a macro investor and analyst is to look ahead in the future and try and figure out where the world is going. I have been using a framework since 2000 of debt, deflation, and demographics. And that framework has been in play ever since. It got me the right side of the financial crisis. It got me the right side of the European crisis. You kind of could see the world through that lens, and it worked very well. I missed the rise of technology earlier on. When I look forwards, the whole world that we understand it is driven by scarcity. And generally, as we've transitioned from manufacturing economies to service economies, scarcity of knowledge is the thing. That's why lawyers get paid so much money, and accountants and financial advisors and doctors and surgeons and all of this stuff, radiologists, is because there's a short number of people, large demand for the services. AI has just made that knowledge a zero. People don't get it yet, but it's all a zero. Being a content creator, creating a media company, a zero. Making films, the cost of making a film will go from $100 million to $5 million or $2 million. So that's the cost element. On the manufacturing side, we're bringing the robots in. So what is the expensive thing of a manufacturing? It's the people. Well, you're just going to get rid of them. Okay, so we're kind of laying off a lot of jobs. Everyone understands that about AI over time, but it's offset by an aging population. So there's less people in the labor force anyway. So that is not the bit that concerns me. The bit that concerns me is, what does it mean for your business or my business when we're replaced by AI? What does it mean for financial markets when we have artificial superintelligence, ASI? Well, as investors, we're replaced because somebody can do it better than us. Somebody can do everything better than all of us. So you start thinking, well, I'm not sure how financial markets even work. Do they just... Well, I don't know, because it's not going to be run by human emotion. It's going to be run by machine emotion or machine logic. Then we start thinking, well, the other thing about AI is right now we've been living this software is eating the world revolution that Mark Andreessen talked about many years ago, and the rise of SaaS software. Well, now it's pretty close already. Let's say you've built a beautiful new platform for whatever, financial advice. I can say, hey, I want to copy Jimmy's platform, but I want it for the Indian market, doing for their regulation, and it'll build it in less than a minute. So what moats do we have around our business? And what moats do we have around the fact that you and I got paid for knowledge? And that scales everywhere. So humans will find new ways of making a living. And I think the online communities is one way, because humans are social creatures by nature. So they want to be around other humans, they want to be talking to each other. But the world is going to fundamentally change in ways that we can't understand. We've never not been the top of the intellectual tree. But if you look at AI, it went last year from an IQ of 90 to a IQ of 157. So we pretty much doubled. If we doubled in IQ, we get to 300 next year, which is more than any human ever recorded. And then the year after that, 600. Then the year after that, 12. I mean, this is la la land, right? So I kind of thought about this and thought, with the exponential change that's coming in all of this technology, even longevity increases for humanity as genetic sciences use this and nanotechnology, is that we don't understand what the world is. And so when I come into a process of massive change, it's going to create societal disruption. It's going to create enormous opportunity, but in ways we don't yet know. The answer for me is if they still have to continue to roll the debt and debase the currency and drive asset prices up, let's use this opportunity to make as much money as possible, that when we go into the early 2030s and the world is starting to move in ways we don't understand, where the study of economics doesn't even really work anymore, that we'll be secure. Because it's much easier to do it from a place of security, because we don't even know what businesses, how our businesses will work in that environment. So that level of unknowing is too much for most people to deal with stress. But we've been given the greatest macro risk-taking opportunity of all time, which has been particularly within technology and crypto, because these are tech adoption curves that are playing into the trend of us being replaced by the AI. So we're investing in our own demise. We can make an extraordinary amount of money out of it. Yes, there'll be cycles and they'll come with risks and all of that stuff, but it'll set us up at a place that we can deal with change.
And what advice would you give young students that are
I
in
do this.
university right now?
I do this all the time because all of my friends' kids are at university or just a bit younger. I had a friend from here in Little Cayman brought his son round to me. He's at university. All the same questions. Firstly, if you are to go into an industry, go into an industry with tailwinds and not headwinds. I went into the banking industry, servicing hedge funds. So we had the largest financial bubble of all time, which was the 90s, which was my career. Hedge funds were the dominant power within that. So I rode two secular trends. If you go into finance and consulting now, it's a headwind because everybody's going to be replaced. So go into an industry, if you want to go into an industry that has a secular tailwind. So that would be AI, robotics, that would be cryptocurrency. So that's what I say to friends of mine. I also say to the kids, if I were you, because you're going to come out in quite a lot of uncertainty, go traveling. Experience people. The greatest skill in a world of machines is to be a human. Go and backpack around India. Go and do something like that, because you will be much more valuable as a human, because the human to human thing is going to be valuable. So I do think there's an element of that, is the more human you are, the more likely you'll be to find a role as things change. Because businesses are going to change. If you do want to go into business and you're very ambitious, go into businesses that are growing at 100% a year. You know, those industries. Don't go into industries that aren't. Now, you could end up deciding, well, you want to be a restaurateur. That's fine, because that's human experience. Travel, travel and tourism, human experiences. So either lean into human experiences or lean into technology. Ignore everything, avoid like the plague everything in the middle, because that's all gone.
I want to summarize a few of the points we've discussed here. And overall, you're very bullish on the US economy, the US markets, Bitcoin. But if there was one risk that a lot of people might not be looking at, it's, you know how sometimes when we get these massive pullbacks, 25, 30% or more, it's something you didn't see coming. And if there was one risk like that, what would it be?
I think the unraveling of the political system in Europe could be one. You know, we're seeing all of these political systems rejecting the previous politicians. You're about to do it in Canada. We've done it everywhere. But does that force the change to the EU itself? And then what would that mean for global trade? What would that mean for, that's a big deal that people don't think about, because they just think of, and you and I talked about it earlier, as Europe as this kind of regulation-driven behemoth. But what happens if that changes? What would that do to the system? Okay, that's something that I don't think people think about, because people always say, well, China's going to invade Taiwan, or or the Chinese economy is going to blow up. These are known knowns, right? So those are not the things that I worry about. Now, the answer to each and every one of these problems is to print more money. If China blows up, print more money. China invades Taiwan, print more money. If there's another pandemic, print more money. If Europe blows up and the world goes to shit, print more money. So what you get is a world where the central banks and governments combined have reduced what's known as the left tail risk, the risk of really bad outcomes. If you think about it, we had the most shocking outcome of our entire lives was the entire world closing down for a 2 to 3 month period. What did it do to the market? It went down for a month. And then did nothing but go up in a straight line. Why? Because we injected massive liquidity and debased the currency. So it's proven. We did it in 2008. We did it in 2012 in Europe with Draghi, everything it takes. Every time we inject incredible amounts of liquidity. Silicon Valley Bank inject liquidity. So we've got into a very different world. It's a world where you're forced to own risk assets. But they've taken the risk of the downside away. Yes, you'll have drawdowns in those liquidity negative years. Yes, the Nasdaq can correct 30%. Yes, the longer duration stuff can go down further, but it won't last long because they'll just inject liquidity.
Interesting points. Raoul, as we wrap up, I follow a lot of your content on both Real Vision and also the Journeyman. I enjoyed your recent discussion with People. I still can't believe he sold that NFT for 69 million bucks. But I especially enjoy your sessions on the Journeyman when you sit back and you open up a bottle of wine and you have a Q&A with your subscribers. Very well done. But if somebody would like to learn more about you and your various services, where can they go?
The best thing is obviously you can go to realvision.com. It's free to join. All of the information's there. Some of the greatest analysts, thinkers in the industry. But as a first step, just go and subscribe to The Journeyman. It's the free YouTube channel. It's my interviews with some really cool people, plus my presentations on the world of macro, crypto, and the exponential age of technology. And we have a fun with a few glasses of wine every month where I answer everybody's questions. And that will then point you in the direction of the various things that I do that best suit you. So go and subscribe to The Journeyman and enjoy that journey, because it's legitimately my journey into the understanding of what the hell is going on. And I've been doing this for 35 years. This is the most exciting time I've ever lived through. And so my job is to go and speak to the most interesting people in the world, learn more, and then occasionally present it back as kind of a synopsis of here's where my thinking is. And I hope people find that useful.
Yeah, I would encourage our viewers to check it out. You do a great job there. But maybe the next time we do one of these interviews, I can come to the Caymans and we can do an in-person interview and enjoy a nice bottle of wine at the same time. What do you think?
Exactly. We can do it at the bar behind me.
Raoul, once again, thank you. It's been a pleasure.
Thank you. Really enjoyed it.